Hey everybody, it's me, Gregory Mannarino. Today is Sunday, January 14th, 2018. I had said on Friday that I was not going to do another video unless something kind of big came along. Well, something kind of big has come along, and that's why I'm sitting here in my Sunday casual outfit getting a video out. But I want you to pay attention to what I am talking about here, and if you think this is important information that people should know, please share this video. Get it out there. So people, what do we know is going on here? There is something concerning, and we've been watching this live. If you've been following it on my website, traderschoice.net, I'm talking about the bond market. It will not be allowed to be sold off in any way, shape, or form. Some entity out here, you know who it is propping up that bond market, throwing salvo after salvo after salvo at it. But again, this is only going to go so far, and we're witnessing something that I think I have been covering before anybody else for years now. I'm talking about the yield curve. I also want to talk about the issue of credit default swaps, which all of the major banks are flooded with right now. Does that sound familiar to you, credit default swaps? Well, we'll talk more about that and what it means for you right here in this video. So, as I am doing this video, in fact, I just checked it, the spread between the 10-year bond and the 30 is less than 30 basis points. What that means is this yield curve continues to flatten out. Now, there's a lot of people out here, even the mainstream has been talking about the yield curve. They have to start addressing this issue because the last two times that we saw the yield curve flatten out and then invert led to market meltdowns. We had the dot-com bubble and we had the 2008 stock market crash. We all understand that this market right now is in some kind of a melt-up mode. I explained to you how we're in some type of a multiple expansion cycle regardless of what the yield curve is doing. It seems to be simply getting ignored. Meanwhile, we've seen this before. We've seen it before. Now, I do not believe, and I would love to hear from you on this point, I do not believe, and I've been saying this, that the Federal Reserve will be able to stop that yield curve from inverting. If the Federal Reserve would have to normalize their abnormal balance sheet at a much faster pace than they are doing now to prevent a yield curve inversion. If they were to do that, it would cause rates to spike very quickly. That would put pressure on the stock market. They do not want this to happen. They want to keep the market moving higher. Also, the weaker dollar, beyond any shadow of a doubt, and I have been covering this at length, the dollar's getting killed. For over a year now, it's been in a downward trajectory that's accelerating over the past few months. And you've seen how stocks have reacted. They continue to move higher. Here's the problem, people, with these credit default swaps that the major banks are holding. The last time we had an issue with credit default swaps was regarding the mortgage meltdown, the subprime market. You remember all that? That's what brought the market to its knees in 2008. So today, I'm just sitting here flipping channels this morning, and all of a sudden it just hit me like a lightning bolt. I'm not kidding. I said the reason why they are so desperate right now to prop up that bond market is the banks are flooded right now, probably beyond belief, with credit default swaps regarding the debt. You understand? What that means is all of these banks that have our money in it, well, they are guaranteeing, understand what I'm about to say, through the mechanism of the credit default swap, they are guaranteeing to pay off that debt in the event of a debt market meltdown. They can't do it. Just like last time when we had to bail out all these banks because of the housing market that was contained by Ben Bernanke. He said, oh no, subprime's contained. It's not going to bleed off. I mean, no other financial expert in the history of the world has gotten something more wrong than Ben Bernanke at that point. Meanwhile, the guy walks into the room and people start to bow to him. I mean, they should throw rocks at him as far as I'm concerned. I mean, think about it. But this is it. This is the reason why we are seeing. I did a video on Friday with some crazy face that had a thinking cap on my head. Well, that thinking cap that I had on my head on Friday actually worked, and it hit me, like I said, a lightning bolt this morning. These banks are flooded with another toxic asset, that is the debt. It can never be paid back. We are going to get a meltdown in the debt market, and they are desperate to prop it up. That's why we've been seeing this, people, over and over and over again, and you've been watching it live right on my website. And every time they get in there and start buying up these bonds, I've explained to you who would want to buy a bond in this environment. Nobody, but now we know why. It's the banks that are flooded with toxic assets like way worse than before, to a much larger degree. They are guaranteeing the debt. The banks are guaranteeing the debt through the mechanism of the credit default swap. That is why bonds are being propped up. That is why they will not allow the bond market to sell off. The banks will go belly up, all of them, in the blink of an eye. Will suffer a global Lehman Brothers moment. And think about it, your cash is in these institutions. Well, what does that mean? Well, if these banks go bankrupt and your cash is in there, good luck getting it out. Good luck getting it out. I'll tell you something else. If this does occur, and that we get let me correct myself, when we get a meltdown in the debt market, okay, we've been hearing some pretty big guns on Wall Street talking about it. Even former Fed chairperson, my God, Alan Greenspan is talking about the debt market and how it could sell off rapidly, causing rates to rise if it sells off. These banks that are holding these credit default swaps are frankly dead. They're dead. There's not enough liquidity. And what would they do? I mean, seriously, in this environment, what would they do? What would the Fed do? Start printing more cash out of thin air? Adding digital money to a screen? We'll watch the dollar turn into confetti overnight. We will end up in a global depression. This is going to happen because, mark my words, these banks are flooded with toxic assets right now with these credit default swaps that can never be paid back. Now we know, people. Now we know who's buying the bonds and why. They're propping up the bond market here. It is incredible. One more thing before I let you go. I've been talking about the junk bonds a lot lately. Now, we're seeing a divergence here that is truly incredible. If you were to take, let's see how many of you actually will do this. Well, I'll just tell you. If you were to take a 10-year snapshot of the S&P 500 and a 10-year snapshot of what junk bonds are doing, there is a massive divergence occurring here. Massive, especially since 2012. It has gone like this. That is also another problem here. Again, you know what I always say, you got to watch the junk bonds. If junk bonds are being bought up, that means the market wants to take on risk. So we got the stock market that is inflating beyond anything. It's historic. We haven't had any kind of, not even a 1% pullback, and as far back as I can remember. We've never seen anything like this before. We got these banks flooded with toxic assets yet again, but to a much greater degree. I mean, this issue with credit default swaps and the banks makes the housing bubble look like, in fact, like nothing we had ever even can dream about at this point. It's just unbelievable, but that's the truth. The debt bubble is going to burst at one point. Don't know when, but watch that yield curve. Again, we are extremely close to the yield curve flattening out. It is going to invert, in my opinion, because the Federal Reserve cannot normalize their balance sheet fast enough. There's there's the problem again. And when you sit there and you're watching the mainstream financial channels and their experts try to tell you that we can have a yield curve inversion and everything is still going to go on normal, perfectly, beautifully normal like it is right now, and in fact the stock market is going to go higher, understand that you're listening to a person that either has something to sell you or has something wrong with them. Seriously, it's very simple to just put these things together, and we've got to use history as a guide here. Seriously, I can't imagine another way that this is going to unfold. And the Fed is stuck. They're stuck badly. They cannot raise rates fast enough to stop the yield curve from inverting. I will talk about this a lot, this yield curve issue. Again, we are less than 30 basis points from a flat yield curve. The next step is inversion. We could literally be weeks away from an absolutely flat yield curve. And the next few pieces that need to be put together here for this entire thing to come down will, in my opinion, fall into place. And these banks and are they're not going to be able to be reliquefied. And that means if you got cash in these institutions, when this whole thing comes down, you're not going to see a dime of that money. None of it. So you need to think about these things. Anyway, look, if you think this video has been important, if I've covered anything here that you think people need to understand, because I can promise you, you will not hear any of this ever on the mainstream financial channel, please share this video. Get it out. I'm counting on you, especially if you're part of my team. Let's do this. Let's band together. Let's at least try to let people hear this stuff so they can make up their own minds as to what they believe is going to happen. Most people, it's going to go in one ear and out the other, but some people will have enough functioning brain cells to understand that we really are very close to something. Don't know when. All I know is we're going to capitalize on it either way. That's what we're going to do. And I want everyone to understand the dynamics behind this. Anyway, that's it. I'll see you Tuesday. Over and out.